You've spent hundreds of hours staring at screens. You've read the books, watched the tutorials, and perfected your setups. You wait for the MACD crossover, check the RSI, and place a stop loss just below a clear line of support. It's a textbook entry. You pull the trigger. Then, the price drops. It breaks through your support line, triggers your stop loss, and locks you out of the trade. Seconds later, the ticker reverses and shoots up in the exact direction you predicted. This specific sequence happens so consistently because you are trading within the indicator trap. Standard technical analysis provides a shared map for millions of traders. When everyone follows the same visual cues, their collective behavior becomes a statistical certainty that institutional algorithms can exploit. The institutions operating on Wall Street actively benefit from the widespread use of retail trading books. This graph shows why these tools fail in high-speed markets. Because moving averages are mathematical derivatives of past prices, they exist in constant lag. When millions use this math, they cluster orders at identical coordinates, turning support lines into predictable choke points. While retail traders watch these lagging visuals, institutional high-frequency trading algorithms analyze Level 2 and Level 3 order flow. Order flow is a real-time ledger of pending orders. It allows an algorithm to see the actual millions of dollars waiting to be executed before the price even moves. Retail traders are attempting to win a real-time war using delayed intelligence. The math is weighted against them before the trade even begins. Look at this heat map. Identical stop losses create high-density liquidity pools. To an algorithm, your safety net is a target. Institutional AI executes a stop hunt, intentionally driving price down to shatter support, triggering panic sells. They buy your discounted shares, then ride the surge upward. Beyond the institutions, many retail brokers operate on a B-book model. These brokers take the opposite side of their clients' trades. They profit directly whenever a retail trader's stop loss is hit. The market functions as a predatory ecosystem, engineered to extract liquidity from the very traders following the textbook. Visual chart patterns act as a decoy, keeping traders focused on geometry while the actual movement of capital remains hidden. In an era ruled by HFT algorithms and AI-driven liquidity, relying on lagging visual indicators has entirely become obsolete. To survive, an independent trader must transition into a solo quant, adopting the same data-driven perspective as the institutions. You have to discard lagging indicators. In a professional market, liquidity is the only data point that matters. Move toward agentic quant trading. This means ignoring the squiggly lines and focusing exclusively on tracking real-time volume delta and order book imbalances. Understanding these mechanics changes your position in the market. The moment you stop reacting to lagging visuals and start tracking the flow of capital, you stop being the harvest.